session on business valuation by CA Sudheendra Rao sir. This session will provide valuable insights into assessing the true worth of a business. Sudheendra sir is a chartered accountant with over 12 years of experience. He specializes in audit, taxation, and financial management. He excels in statutory and forensic audits, GST, TDS, and financial reporting. Let's welcome CA Sudheendra Rao sir.
Good morning, Maminda. Thank you, organizers, for giving me this opportunity to speak on the topic, which is valuation, which is essential not only for the existing entrepreneurs, it is also essential for the emerging enterprises. India is transforming into developed economy from developing economy. So, in this scenario, many of the startups are coming into existence, and even existing businesses are also expanding it to global. So this in this scenario, this necessitates know what is its worth. It helps to understand what will be the future prospects of the business, whether it is mergers or acquisitions or for fundraising or understanding the value of the business. It is essential for the stakeholders to know what is the value of the business currently and what will be the future prospects. This will help the decision makers to take informed decisions. Business valuation is basically determining the economic value of the business. While doing this exercise, we will be considering various components like what is the tangible assets, what are all the intangible assets, what are the cash flows, what are all the liabilities, and what intellectual properties they have, and what is the brands they have registered, what is the equity, and what is the future potential of that business. So, this valuation is not only just confined to one particular business segment or industry, it is expanded to various sectors and industries like real estate, FMCG, FMCD, or infrastructure as well. And for a startup, why this business valuation is very important is, for example, an entrepreneur has an idea. To convert that idea into revenue generating business activity, he need to have some funds which he may be lacking. So for that, venture capitalists or strategic investors will come into picture. So they need valuation reports to determine whether those ideas are economically viable, operationally feasible, and legally acceptable. Based on these assessment, they will decide whether to go ahead with this investment or not to go ahead. And second point is, in case of mergers and acquisitions, or even in case of demergers also, demergers or reverse mergers, or a large corporate want to sell off one of its business segment. So these valuation reports will become essential to determine the swap ratio or to determine the price of. These valuation reports are not only useful for internal management purpose, regulators are also looking for the valuation reports. Like for Companies Act, if you are going for future expansion or further issue of equity, so they need the valuation report to be attached. It is a mandatory document. And SEBI is also looking for valuation report in case of private placement or preferential allotment of shares, or even in case of delisting also they need the valuation report. They want to know the value of the company. And in case of FEMA, if Indian company is making investment into some foreign company or vice versa, so FEMA needs valuation reports. Not only regulators, now in case of disputes between the shareholders, or in case of dispute between the business partners, courts or arbitrators need the valuation report in disposing of the case and give some resolution. From with effect from 1st April 2016, for listed companies and companies having net worth more than 250 crores, they have to comply with Ind AS requirements. As per Ind AS, we have to report not book value, it has to be at fair value. So some of the items are like investments, financial instruments, and goodwill. Before 2017, valuation was not much regulated in India. But with the introduction of IBC from 2017, so valuation is getting regulated through IBBI. IBBI is nothing but Insolvency Bankruptcy Board of India, and valuation cannot be done by any other person other than the registered valuer who registered with IBBI. There are broadly three approaches for the valuation. First one is income approach. Under income approach, we have to take the future cash flows of the company, and we have to arrive at the free cash flows available, and then we have to apply some discount rate, and we have to arrive at the value of the company. Second method is market approach. Under this approach, we have to look for some listed entity which is similar to the company being valued. So it may be difficult to get the peer listed company. The third approach is cost approach. Under this approach, if the company is having huge fixed assets base, then we can apply this method. There are few challenges while valuing. While doing valuation exercise, getting reliable data is very difficult from, especially from small or startup companies. And under market approach, getting a peer company which is similar to value company being valued is very difficult. And though we say theoretically valuation should be unbiased, in practical scenarios it is always biased. Why I am saying is, who is getting the valuation and whether it is buyer or seller, the valuation will favor either buyer or seller. It cannot be unbiased. So in a startup company, getting the data which is not yet started its business, getting a reliable data, revenues or estimates is very difficult. That's it from my side. Thank you for giving me this opportunity.